Hey everybody, today is Friday, July 31st, 2015. This is the Profit Builder Weekly Review. It's the end of the week, it's the end of the month. It's time for us to assess how did we do during the month of July. I'm Mark Dannenberg. I'm the founder and CEO of Options Moneymaker. I created the Profit Builder program specifically to help traders learn how to trade simply and grow a big account. So we want to help you learn how to simplify your trading, not make it overly complicated, make it simple, something that you can weave into your trading day, into your life, and be successful in taking profits that you deserve from the market. So let's take a look at our account here. We ended up today having taken profits on here, Friday, July 31st. We took profits of $227.79 today. That is after fees and commissions. When we take a look at our week-to-date performance, I'm going to start Monday, July 27th through Friday, July 31st. Go. We have $1,282.87. We're going to jump over to our spreadsheet and we're going to plug that in. We've already plugged that in, $1,282.87. So this program, Profit Builder program, the really cool thing about this is it allows traders to start by putting up risk capital of $5,000. Now, anyone who is a serious trader is going to realize that that's not a huge amount of capital to put at risk in the market. You can start with smaller amounts, but we start with $5,000. That is not the size of the account. This particular account started with $11,000 at the beginning of the second quarter of 2015. So at the beginning of the quarter, last quarter, we started with an account size of $11,000, and of that $11,000, we were willing to put it at risk in the first week, $5,000. It doesn't mean necessarily that we're going to have the full amount at risk. It just means that that's the amount we are willing to put at risk. We estimate an 8% profit per week. We estimate 8% profit per week, and we just very simply calculate what that would be. So we're looking for $400 worth of profits in the first week. We then compound our weekly investment allocation, our weekly risk amount, based on how much we actually make. So in this particular case, the first week of the program, which was the beginning of last quarter, we made $653. And so the next week, our risk allocation, the amount we are willing to actually put at risk, is $5,683. That's the original $5,000 plus the profits that we took of $653. And we continue to do that every single week, even when we have a week where we have a loss. Here, the week of May 4th, we had a loss of $257. So the following week, the amount of risk that we're willing to allocate is actually reduced from what we were willing to allocate the prior week. So we continue to do that throughout the quarter. So last quarter, we earned a return of 127.9% based on our starting risk capital of $5,000. That was $6,396 of profits for the quarter based on $5,000 of risk capital. Now, we never exceed our risk capital. This is a guideline for us that keeps us in the game, keeps us relatively conservative relative to our total amount of capital available, and helps us manage our risk. It's one of the things that a lot of traders have a hard time keeping track of, and they get themselves in trouble when there's a lot of enthusiasm and a lot of emotion, positive emotion around opening new positions. They lose track of how much capital they should really be allocating. We use a very, very simple spreadsheet to keep track of that. At any given time, I can look at the spreadsheet and determine what my weekly allocation of capital risk is. And if I am coming close to that number, I will just cease opening new trades. But ultimately, the objective here is to attempt to earn at a rate that is equivalent to 8% of our allocated risk capital. Okay, so bottom line is we had a great quarter last quarter, and we track week by week. We provide a weekly update to all of our subscribers, and everyone who follows along with our alerts sees what our actual performance is. And remember, these numbers are net after fees and commissions. Get a lot of questions about how commissions eat into profits, and you don't have to be at all concerned as we report our numbers. That 127.9% last quarter was net after fees and commissions. So it's a pretty solid number. So that brings us to this quarter. This quarter, we started over at the beginning of the quarter with $7,558 of risk capital. Now, that's less than what we had finished last quarter with. And why is that? It's because we don't want to just continue to compound. We take a very conservative approach with this. We want to continue to compound in a way that will help us grow, but also in a way that will set aside a portion of our profits in cash that have zero risk to them. So what we simply do is we started over the new quarter with $5,000. That's the same original $5,000 that we were willing to risk prior quarter, plus 40% of the profits that we took last quarter. So we just have our spreadsheet set up to determine that for us. 40% of the 6396 plus the 5,000 says that in the first week of this quarter, we started with 7558 of risk capital we are willing to put into play. Now, we've accumulated profits so far this quarter, and we just put up profits again today. So far, we've had profits every week for the 5 weeks of this quarter so far. Our target for this week was to have capital of $12,485 at risk. That's how much we are willing to put at risk. But like I said, it doesn't mean that we have to have that amount at risk all the time. If we can earn our profit target without having the total amount of capital at risk, we are really doing well and in great shape. And so over here, look at our actual risk. Our actual risk right now is $10,338, but we are willing to allocate as much as $13,768. So we still have another $3,400 of potential risk that we could put in play. And yet we closed out this week with $1,283 of profits, $1,283 of profits. Our target profit for this week was $999. So we beat our target for the week, but we did not have the total amount of risk in play. Now, I've already moved this risk down by 1 week, so we're prepared for next week. This is the total amount of maximum risk we had in play, the $10,338. That was in play for the current week that we are ending, and that means that we had another $2,000 of risk that we could have put in play. So we basically put in less risk, but still beat our profit target by about $283. Great combination of factors. Now, how are we doing this? Well, very simply, it is simple. Let me take a look at charts. If we take a look at a chart of the Russell 2000 index, this is a 60-day, 60-minute Russell 2000 index chart. What we're doing is we are trading the cycles of the indexes. And once you become familiar with this, it's very easy to do. This is all about keeping it just as simple as possible. We try to keep every aspect of our trading simple. We don't want to spend all of our time trying to figure out where the next trade is. We don't want to spend all of our time worried and obsessed about our trades. And we definitely want to stay off of that emotional roller coaster of euphoria because you had great profits to completely discouraged and depressed and maybe even thinking about giving up trading because you had some losing trades and they wiped out your profits. We're going to try to avoid that. Remember, go back to our spreadsheet and look at the number of weeks that we have put on our spreadsheet since the beginning of last quarter through today. Out of all of those weeks, we've had 3 weeks where we've had losing weeks. Having a losing week is not a big deal because in the big picture, we are putting up more gains than we are losses. And this one is one of the reasons why we don't measure actual win-loss ratio on a per trade basis. Most traders will start focusing on win-loss ratio. They think that somebody's got a great system if they're told that they have an 80% win-loss ratio, where they win on 80% and lose on 20%. That's not a great measurement. In fact, it's a very misleading measurement. If you have 80% of your trades as winners, but you made 50 cents on each of those trades, and you have 20% of your trades that are losers, but you lost $2, $3, $4 on each of those trades, you're not going to be doing very well overall. We keep this very, very simple. We trade the cycles of the indexes, and our only report card to determine whether or not we are successful is the total dollar amount of our profits or loss at the end of the week. That's all we care about. So we trade the cycles. These indexes, the 3 indexes that we trade, they cycle up and they cycle down. And when you recognize the patterns based on support and resistance and based on Bollinger Bands, it's as simple as it can be. We don't use complicated technical signals. We don't use a ton of stocks that we trade. We're not constantly out looking for the next available optionable stock that we can place a trade on. We get very, very intimate, very familiar with, very knowledgeable about our indexes, and we trade those cycles. Every cycle up and every cycle down is a potential profit opportunity for us. Those are the cycles that you want to learn to recognize, and those are the things that we help teach our clients how to recognize. Whether a market is trending higher or a market is trending lower, there will be up and down cycles. Now, I'm frequently asked, Mark, you're doing so well, but what happens when we have a really strong down movement, when we have a major sell-off, when we have something like what happened in 2008? Well, the answer is very, very simple. Even back in 2008, there were up and down cycles. So if we were to go back and look at that period in 2008, we would see that although the trend was actually moving lower, there were up and down cycles on days, on a daily basis. So if we go back and we look at where the market really started to crash, and we can all rewind and look back now and know what happened, but what we saw during that time is we saw big down moves and we also had big up moves. We saw cycles occurring that were all opportunities for us to take profits. Even in the midst of all of that decline, for example, in the middle of November of 2008, we had not yet reached the bottom of the market. From the middle of November to 2008, 11/21, to January 6th, 2009, we saw a very strong up cycle in the midst of all of that market turmoil, economic turmoil that the market ended up suffering. So the very, very simple answer to the question is, how does this method hold up in strong sell-offs? Is very nicely. That's the simple answer. It holds up very nicely. And if you become familiar with trading the cycles, then this is an opportunity to take advantage of each of those cycles to leverage profits. Now, the NASDAQ 100 is the second index that we trade. These are not ETFs. These are not futures contracts. These are trading options on the indexes. trading options on the indexes. So what we see here is a pattern on NDX where today, for example, we moved up to a high. This was an up cycle that was moving up, and we reached a top where we saw a strong line of resistance on a declining channel. The market turned and headed lower. NDX turned and headed lower after hitting that level of resistance. You don't know this yet if you've not traded along with us. Each of these movements is an opportunity to take profits. We don't do any day trading. We do longer term trading, and longer term for me is 24 hours to maybe a week. And the types of profits that we've put up, the percentage increases that we've experienced on our account are all due to that method, okay? So we look at the cycles, we pay attention to the cycles, and we leverage them in order to place our new positions in the market and look for the quickest opportunity to take a profit. S&P 500 is the third index that we trade. So it's the Russell 2000, which the symbol is RUT. It's the NASDAQ 100, the symbol is NDX, and the S&P 500, the symbol is SPX. We see a declining channel, just like we did on the other two indexes. We see that today the index moved higher, coming right up against a declining line of resistance, and then it traded off of that. You see, folks, this cycle that moved up strongly from Monday through today and then fell off, all of that is opportunity for potential profit. There are two rules we put into all of our positions. One is we're always going to build in a forgiveness factor, and that forgiveness factor is based on where we place our strikes, where we place our risk point, and we use Bollinger Bands, support and resistance to define that. And the second thing we build into every one of our trades is time. A lot of people understand credit spreads, they understand iron condors, and yet they consistently fail at consistently generating profits. We are not interested in doing that. And one of the reasons that they fail is because they trade very short-term expirations, and when the market moves against them, they have no opportunity to adjust or manage that trade. We are very big believers in adjusting and managing trades, and our track record proves that it is absolutely the right thing to do, and we always give ourselves time in each trade to have the luxury of being able to make an adjustment. So we build 2 to 4 weeks into every single trade. The other thing that that does for us is it means that we don't have to be present all day long during each market day in order to trade successfully. We don't want to be outside of market hours worrying about our trade. We don't want to have to lose sleep at night because we think that perhaps the market's moving against us and tomorrow is expiration. That is not the proper way to trade. It is not a way to trade where you are going to feel comfortable with what you're doing. So we build time into each position, and we build a forgiveness factor into each position. So bottom line is, end of week, we've finished off another week with a strong set of profits. Again, that is profits after fees and commissions. We've tucked that into our spreadsheet where we now see that we have $1,283 of profits for the week. We have a great quarter going. We're up 82% for the quarter after finishing last quarter at 127.9%. So we're just looking forward to next week. We have a lot of people that tell me that we've changed their lives in terms of they look forward to trading now. They don't fear the trading, and they have knowledge about how to properly trade. So my purpose is to just give you an update, share with you our results. If anybody is interested in following along with us, what we do for you is we will educate you over a 6-month period how to follow our trades and how to duplicate what we are doing. We give you an education video every day, 5 days a week for 6 months, every market day, 5 days a week for 6 months, and it is a complete 15 to 30 minute analysis of what's going on in the market, evaluating each of the index charts and evaluating any positions that we hold and sharing with you our views of what we need to do in order to properly nurture that position along to a profit. Follow that along for 6 months and you will be head and shoulders above most other traders that you might be familiar with in terms of your knowledge and comprehension of how to interpret different cycles of the market and how to respond to those cycles versus reacting to those cycles. So that's the update for today. Again, I really appreciate you stopping in and listening to us. We will be back next week with an additional update. Once again, I'm Mark Dannenberg, founder and CEO of Options Moneymaker, and this is the Profit Builder Weekly Review for July 31st, 2015.